let's talk about SPX for income only. Credit spread, SPX credit spread, and SPX Iron Condor. So I'm going to try to do my best. Everybody, this is something that I do. I love the SPX because the SPX, 1 SPX equals 10 SPY. So from the get-go, you save in commissions. But in addition to that, the SPX is a cash settle instrument. So you don't have assignments. So there's monthly SPX and weekly SPX. So I'll show you how I structure some of that trade, and hopefully that'll be helpful to you. So let's go, and let's go deep to the chart. So, for instance, we are at 41.70 right there at the close today, right? Let's say I want to do 8 days out, call credit spread 42.25, 42.30. I would be able to collect a box, which is about 10% in a week. Well, if you could, and again, it's not a promise, I structure those where I try to make at least 10% when I do them per week, right? Collect about 10% on the premium, right, out of the money. This is a pretty good premium. So I like usually to be 10 point wide on both sides of the credit spread, especially if I do deep iron condor. And I do also day trading with them. So let me show you a couple of things on SPY credit spread to help you. Number one, the SPY is the mother of all indexes. The biggest professionals in the world trade SPX. One thing also is that SPX has a lot of tax advantages. So it's cash settle, no assignment, as I told you, and it has a 1256 tax code. So the tax code, the 1256 tax tells you that the capital gain on SPX are taxed at a 60-40, which means what? That 60% of your profit, guys, are going to be taxed as short-term capital gain with a lower tax rate, you know, and 40% of your profit will be at the long-term capital gain or ordinary income. This is huge because let's say you make 100K profit, 60K, let's say, will be taxed at 20%, let's say the long-term capital gain, and 40K will be taxed at your ordinary income. Well, if you are in the high bracket, that's 39%. So a lot of hedge funds sells a lot of SPX credit spread and puts, you know, to make income that has a preferred tax advantage, okay? Tax efficiency. Now, in addition to that, what I like about the SPX is the commissions that you save, okay? Now, SPX is 1/10 of the commissions of the SPY. Why? Because 10 SPY equal 1 SPX, which means that if I do a credit spread with this, I pay the same commission that if I was doing 10 commissions here. So I save 1/10 of my commissions here. So it's much more efficient to trade SPX for income. I save for income. So let me show you why. Now you have the monthlies, and you need to be very careful about the monthlies because the monthlies, guys, they expire. So be very careful of that. The monthlies expires on Thursday at 4 p.m. and they settle on Friday. So be careful. That's a trick that a lot of my guys, when they don't know that, they get caught up on. Avoid the monthlies because you'll get caught up on closing on Thursday at 4 p.m., but settlement will happen on the Friday price. And that's super tricky. So don't do those. Avoid the monthly, stick to the weekly. They expire at 4 p.m. and try to get out by 4 p.m. So, two ways that I trade the SPX, and that's what I'm known for, you know, trading the SPY and the SPX, guys, for income. 1 SPX, 10 SPY, that's the commission. Another way why I am a big fan of is look at the bid and ask spread. The bid and ask spread on the SPX is large, you know. This one is not showing you, but look on the options here. You know, you have 50 cents here, you have a point, you have 3 points, whatever it is here. It is large bid and ask spread. Bid and ask spread that is a little larger is okay if you trade SPX and you sell the options. Now, larger and wider bid and ask spread is a killer if you do directional trades, if you are the buyer of options, if you buy the puts and you buy the calls. Okay, so if we go back here, in this case, if I was to do 42.25, 42.30 with a 41.70 current price call credit spread for next week, I would stand a chance to make 10% return on investment. But there's two strategies that I like. All right. The first strategy that I gave my guys, here are our notes from our live private trading room on Monday, is I gave them a trade, and this has been already, people took a class not long ago on Master Options class with us, and they've gone through the class with being in the live room, and we did 5 SPX trades. And those 5 SPX trades, iron condors have been winners. And those are very wide, deep out of the money. So look here what we've took for this week. 42.50, 42.80, it's a 30-point wide, with a 38.85, 38.55 iron condor on the SPX to make 40 cents. 40 cents, it's a 1.3% return on your money. So some people might say, oh, this is shit. But this is not, guys. This is super powerful, because if you can make 1.3% to 10%, so this is what I look for. When I am aggressive, I go for 10% rate of return on my SPX credit spread or iron condors to 1.33% per week. If you can do that times 52 weeks, you are going to crush the rate of return of Warren Buffett. Again, I cannot promise it to you. I can only share with you 27 years of experience of doing it with real money. You know, this is what I'm known. If you look at 400 of our video or 300 of our video, you'll notice the biggest real account, real money profit are always on the SPX and the SPY. Always. It never fails. And then from there, what we do is we transfer the money. We transfer the money from the day trading account or swing trading account trading SPX and SPY, and we buy asset by selling the put deep at the money. We acquire assets in which we get paid by selling the deep at the money put. We get the time decay, bang, I get the stock, the asset, and we're acquiring asset while getting paid to acquire asset at the price, at the support zone of our day trading zones that we want, you know, to acquire and keep over time. But this is purely income. This SPX trade, iron condor and credit spread are purely income. So one of the trades you just showed is deep out of the money, iron condors. I like to open them for 5 days to 7 days. Okay? And I'll take some questions on the live stream after. This is for the people who will listen to the shorter version of that video, right? The second way that I like to do those trades is for day trading at the money. So let me show you. The day of expiration, sometimes it's very aggressive. Very aggressive. When I trade for day trading, I would take, for instance, today is Thursday, I would have taken the one expiring tomorrow, and I would have said to myself, okay, the market is uptrending. So first of all, always look at your chart, obviously. What is the trend? Well, look at our retail tools here. What does it say? Main trend up. This is the main cloud, green. Intermediary, immediate cloud, up, green. So you would look for longs. If you look for longs, you sell put credit spread out of the money. I would sell somewhere here to create a safety of margin around the 4,075, 4,100. That's the deep out of the money. Now, if I wanted to be more aggressive, I would go towards the cloud support around here at the edge at 41.50, 41.40 today, and I would have sold the put credit spread expire tomorrow. And that's what I would have done at the open this morning if you were doing it for day trading. So let me show you. When you day trade, it's easy. You put just 10 strike, and I would have done the 41.50, right? Put credit spread right there to the 41.40. And that would have been the trade I would have done this morning at the open. And you do them at the money. Why? Because if you are wrong, and I'll show you quickly, it's a little bit more complex, it's called defending a credit spread. They go up, and this is your 41.50 strike. Everything look good. You have the day trading zones at 41.50, and then you have the day trading zones at 41.75. Everything looks good. But then suddenly, boom, crash. Passes 41.50 the same day. What I love about this is I can buy back quickly my 41.50, leave my 41.40 put, which would be close to the money. You know, let's say we're at 41.45. The market cracked all the way to 41.25. Now I am long put. So credit spread, when you have a back ratio, it's called a back ratio defense, are very suitable when you buy back the short leg for defense. If you buy back the short leg here, you are long put, which means you flip your delta. When you do a put credit spread, you want the market to go up. But if the market cracks down and you buy back your short put, now you have a long put and you stand a chance to catch back your losses and make money. It's a back ratio. We teach that and we help you understanding that. And there's a lot of videos that you can watch on our YouTube channels to help you navigate that. Okay? So it's called a credit spread. So I recap, everybody. 2 things that I like to do. An aggressive at the money credit spread for day trading and a deep out of the money iron condor. Now, notice that each time you are going to do a credit spread, your risk is on the short leg. Your risk is never on the long leg. Look, people are nervous on very deep iron condor credit spread. Look, if I was to do a very deep one here, look, let's say I sell the 41.50 again, but this time I buy 4,050, 100 points below. What people don't understand is like, oh my God, this is so super dangerous. Now I go for $3.90. But the real risk of that trade is here, guys, is on the 450, on the short leg. Because that 450 long put is worth probably nothing. Look, if I scroll down and I put all strikes here, and I scroll up to the 4,050, look what you're going to see here. You're going to be like, surprise. If I can get to that 4,050. So look here. Hopefully we'll get it. 4,050. 4,050 again. 4,050. Boom. It doesn't let me. Here, boom, 4,050. Where is this? 4,050. Something is not right. Oh, you know why? Because look, I need to go to the top here. It pushed me over. The one that expires here. So look, 4,050 here. Look. The one expiring tomorrow. Here we go. Now we're talking. Look where the risk is. 30 cents. It's only 30 cents. So you see the risk is not on the long leg. So let's recap, everybody. Okay? When you trade SPX, you get tax efficiency with the 1256 code. That's number 1. You gain 1/10 of the commissions you pay on the SPY credit spread. When you trade credit spread on the SPX credit spread, you also do 2 strategies that I like. The deep out of the money iron condor, 5 days, 7 days at the beginning of the weeks, or the at the money for day trading 10-point wide. I just show you also a last but super important point on SPX credit spread and anything SPX or credit spread. The risk is on your short leg. If you go super wide, as you see here, it doesn't matter. The biggest risk is on your short leg, on the short 4,050, because here on this example, the 4,000, what was that? 4,050 is only worth 50 cents. So I hope it was helpful, everybody. Your likes, comments are super appreciated. And hopefully you can learn below this video how I turn two accounts, one account from $28,000 to $121,000 of real money posted and streamed on YouTube last year on February 19 and on. And there's another video you can stream under our video playlist called the $10,000 to the $42,000 on the SPY. So hopefully these SPY, SPX videos are helping you. But at the end of the day, don't forget, whether you do SPX credit spread, SPY credit spread, it's all about getting that income out of your day trading and swing trading account to sell deep out of the money, put do the trifecta, to buy stocks, to buy assets that you buy and keep for the longest time, that will compound over time, split and compound for real wealth. Okay? I hope it was helpful. You take care, everybody.